Clorox stock ticker CLX, is currently trading at $138.23 per share. Year to date, they're down 21%. Now, this is a company that dividend investors are starting to watch closely because that gives them a starting dividend yield of 3.43%. And this is also a company that is almost a dividend king. They've been increasing the amount they pay in dividends for 45 consecutive years. Now, they did recently release their earnings report for the most recent quarter. And if we scroll down, there's one thing I do want to point out. We can see adjusted earnings per share decreased 23% to 93 cents from $1.21 in the year ago quarter, due mainly to lower gross margin. That has been a huge problem for the company as of late, and something if we do jump over, this is over the past decade, we can see their trailing 12 months earnings per share. We can see it was pretty consistent, spiked up quite a bit during 2020 for obvious reasons, but there's been a huge plummet over the past couple of years, so not a very good sign for the company. But in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Clorox. And on the spreadsheet, we're going to be looking at 4 different valuations. We'll be looking at Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, the first thing we're going to do is we're just going to come up here and plug in the stock ticker for Clorox and hit enter. And you can see all of this data is going to automatically load in. Now we're currently looking at a 750-day change chart. So you can see it has been a pretty drastic decline to its current trading price of $138. Now if we come over here, we can see they pay out $4.72 per share, giving them a yield, like I said, of around 3.4%. Payout ratio is alarmingly high. That is something we'll have to look at a little bit later in the video. But if we come down here, we can see analysts currently have a target price of $129. One of the few stocks that analysts currently have a lower price target than the current trading price for this company. Now the beta is about 0.31, so you should see very low volatility levels for this company. But let's go ahead and move forward and look at Graham's valuation. And Graham's valuation is a valuation model invented by Benjamin Graham in order to calculate intrinsic value. And here's the formula he lays out for us to do so here. And there's going to be 3 main drivers of this formula. That's going to be the earnings per share, our growth rate projection, and the current yield on AAA corporate bonds. And like I mentioned earlier, the earnings per share has been declining as we saw in our chart right here. So currently sitting at $3.27 per share. Now growth rate projections are still decent for this company. It's expected to grow at a decent rate right here, as we can see a 14 growth rate projection, but the current yield on AAA corporate bonds is quite high when you look at it in comparison to the past few years, currently sitting at 5.1, which will lead this to a lower valuation, which we can see right here. We come to an intrinsic value of right at $59.24 per share, quite a bit lower than the current price of this company. Now keep in mind, the current yield on AAA corporate bonds is something that was sitting around 2.8 at the beginning of this year. And if that were the case, the intrinsic value jumps up quite a bit. So the economic activity we're seeing right now is definitely leading to a lower intrinsic value with Graham's valuation. But let's go ahead and move forward and look at our discounted cash flow model. And in order to perform this model, we need to project a growth rate to the future free cash flows for this company. So you can see here, I plugged in the historical free cash flow for this company right here. And this allows us to see our year-over-year growth rates. And we can see that the average growth rate over the past few years is around 3.43%. Now it's declined by a large amount over the past couple of years, as we can see right here. So we are expecting it to grow a little bit faster than that. We're expecting a growth rate of around 14%, just like Graham's valuation. So I'm projecting that growth rate to the future free cash flows and the terminal value, which is the sum of all the future free cash flows past the year 2030. We then found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, and subtracted out their total debt to get their equity value. After I had that, I divided by the number of shares outstanding, and I came to a discounted cash flow price per share of $152 per share. Now moving forward, we are going to be glancing at the multiples valuation, and the idea behind this multiples valuation is we should be able to value a company based on how the market is valuing companies that are similar in structure. So you can see our comparable companies right here. We're taking their stock price, dividing by the earnings per share to get our price to earnings multiples right here. We then take the average price to earnings multiple and we multiply it by Clorox's earnings per share. And you can see we come to an intrinsic value of $77 per share. Now keep in mind again, that lower earnings per share is going to lead to our lower valuation here because it's dropped so much. Let's say their earnings per share was a little bit higher like it used to be, maybe around 6, and hit enter. And we can see that leads to an intrinsic value pretty close to their current trading price. But again, that lower earnings per share is definitely going to hurt them in this valuation model. Now moving forward to our last last valuation, the dividend discount model. Obviously an important valuation if you're an investor like me. I like to focus on dividend growth companies. And that's how this valuation model values company based on how much they grow their dividends and how much their dividend currently is. And like we saw on our stock screener over here, current dividend yield pretty good, sitting at 3.41%. If we see right here, I plugged in the quarterly dividend payouts so we can see their yearly dividend payouts, and this allows us to see the year-over-year dividend growth. Really good year right here of 10.4%, 4.7%, 4.5%, and then a little bit lower as of recent at 1.72%. So the average growth rate over the past few years is sitting at 5.34%. Something you will notice, obviously, it has been declining over the past few years. So at the moment, I'm projecting a growth rate of 5.25% with a discount rate of 8.5%, which leads to a dividend discount model price per share of $152 per share. Now, something we do have to keep in mind if we jump back over to our stock screener, that payout ratio is quite a bit higher than it typically has been in the past, and that's due to the fact that the earnings per share is so much lower than it has been. Now, I do expect the earnings per share to recover a little bit and get a little bit better, but because of that, I don't think the growth rate will be able to hit quite at 5.25%. So we're going to go ahead and lower it to about 4.75% in this scenario. And you can see that drops down our dividend discount model price per share by $131. Now, something you do have to keep in mind is if this earnings per share does not get quite back to where it needs to be, then this dividend is definitely going to be in jeopardy. I think for the time being, it is safe, but it's something to keep an eye on. Now, jumping over to our output tab, we're going to see all four of our valuations: grams at 59, multiples at 77, discounted cash flow at 152, and dividend discount model at 131. And when we average all four of these together, we come to an intrinsic value of $105 per share, quite a bit below that current trading price of the company. So we really don't even need to apply a margin of safety. But let's say we applied a 10% margin of safety based off of that. With current market conditions, our acceptable buy price for this company is around $94.72 per share. Now, I think when you look at the starting dividend yield and the historical dividend growth and the 45 years of dividend growth, it is obvious to see why people are keeping an eye on this company, but that lower earnings per share is still quite a bit of a red flag for me personally. It's kind of making me stay away from this company. As for me, I'll probably keep them on my watch list, but I don't currently plan on adding shares. But if you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. With that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.